Welcome to Wealthion. I'm Wealthion founder Adam Taggart. Glad to be here at the end of this week. I'm joined as usual by my good friend, portfolio manager Lance Roberts, and we are here for this week's weekly market recap. Lance, buddy, how you doing?
I'm great this week. It's been a good week.
I'll bet. So for those that haven't been watching, the S&P is up about 100 points so far this week. Pretty steady up week, up every day this week. And I got to hand it to you, Lance. You called it. You had told us that buy signals were in place. And even though things were looking really pessimistic with, the banking crisis and all the other things that we've been talking about, you were saying, don't be surprised if this market rips higher. And at least that's what we got this week.
Yeah, and again, we're probably not done yet. We probably still got a couple more weeks of move higher here. Now, it's not going to go straight up, right? I mean, it's probably going to, sell off a little bit, maybe Monday, Tuesday, and then have another rally towards the end of the next week. But yeah, we're not overbought yet. Buy signals are firmly in place. They're nowhere near overbought right now. So, over the last couple of weeks, we've been adding equity exposure to the portfolio. That's been working well. And at some point here, we'll get those signals back to very overbought conditions, and we'll take profits and reduce risk accordingly. But right now, there doesn't seem to be a lot standing in the way of the markets at the moment, particularly after we cleared the 50-day moving average yesterday, and then really followed through today, on Friday. So we've now cleared really the only kind of resistance level until we get back towards 4,100 to 4,200, which is where we were back in February at those peaks. So we've got a little bit more room to go over the next couple of weeks. And April tends to be is the second strongest month of the year also. And we're still in the seasonally strong period. So kind of a lot of tailwinds here.
Okay. And it's interesting you said tailwinds. So I was reading some premium Goldman Sachs research right before getting on here, and their big technical guy there, Scott Rubner, I believe is his name. He says that, quote, technicals are extremely favorable starting today. Yep. And he basically had said, look, the first part of the year, markets had a headwind in their face. Now, though, they've got a tailwind. So he feels similar to you. I was going to ask you about the technicals, but you already sort of pre-addressed them. You said we kind of broke through the last big ceiling the market had to crack through to start to run here. But let me ask you this. So, you and I have many times already sort of talked about the arc of where the markets could go this year and the fact that recession is still kind of looming out there and whatnot. Let's say we get a run up to 4,200 or so. I know you're not the bull, you're not the bear, you're the eagle. You're just up there looking, is it overbought, is it oversold? Yep. Of course, if it gets to a point where it's oversold, you'll say start lightening up. But do you see this run as something that could sustain throughout the year in general, or like, is this the last hurrah, more like a last hurrah, like to sell out, at good prices before maybe there's another leg of the bear market?
Well, there's, so this weekend's newsletter that I'm writing right now, and we'll have it published tomorrow at realinvestmentadvice.com, is it's kind of talking about this very thing, right? On one side, you've got every really historical good recession indicator pointing to a recession, right? So the 6-month rate of change of leading economic indicators has a perfect track record for predicting recessions. That's in recession territory right now. Inverted yield curves, we've talked about. Our economic composite index, which has 100 different data points that covers everything from manufacturing to service to even international and leading economic indexes, that is also in recession territory. So, and that has a perfect track record also of predicting recessions going back to 1970. So, there's, all this data out there that says, hey, the economy is going to go into a recession. And yet, economists right now are raising their economic growth rates for the rest of this year. S&P, which, take FactSet, throw it out the window. It's complete crap. Never use FactSet. S&P is the one that produces the earnings estimates, and they're gap-based for the S&P 500, right? So if you ever want to look at earnings, look at what S&P Global produces. That is actually suggesting that earnings are going to rise to the peak of January 2022 by the end of next year. So quarter one will be the trough in earnings, according to the S&P, And by the end of next year, earnings will be back to where they were January of 2022. So that's a very optimistic outlook. And we talked about last week, I think it was last week, that, look, if you're a buyer of gold, all you care about is real interest rates. Whatever direction real interest rates are going, that's what tells you to buy or sell gold. When it comes to the market, it's about earnings estimates. And right now, those earnings estimates are moving up, not down. So that's giving a tailwind here because investors are looking at the valuation of stocks going, yeah, they're expensive right here, but if earnings grow by the end of next year, that valuation is not so expensive. So investors are starting to buy stocks in anticipation of a recovery in earnings. And here's what's interesting, right? So since January, 88% of the rally this year has come from 10 stocks. I wrote about this back in October of 21, because at that point in October of 21, now remember, this is before, this is the tail end of the whole.
Before the wheels came off, yeah.
Right. 80% of the rally was being driven by those same 10 stocks. And of course, we had 2022. Well, we're back to that. And what was interesting is November of last year, and you and I talked about this when we were doing the interview, I wrote that stock. I said that article called "Are FANG Stocks Dead?" Because everybody was saying technology's dead. Nobody's on FANG stocks anymore. It's over. That and you have, what we said then is don't count them dead yet. Everybody thought energy was dead in 2021. It was the best performer in 2022. Don't count FANG stocks out because everybody thinks they're dead, and they're typically not. This year, FANG stocks, your best performer, energy is your worst performer. So, it's just this rotation in the markets that's going on, and investors are making bets on where they think the economy and earnings and the markets are going to be. And right now, that bet is no recession. I don't know how you get there, but that's what the bet is.
All right. Okay, a couple questions on that. One, you mentioned yield curves, inverted yield curves as a predictor of recession. You've always said you get a notice when the yield curve inverts, but then you get to watch when the yield curve uninverts, because that means the fuse is lit, right?
Right.
We've got some yield curves that are really uninverting right now, right? Okay.
Yeah, the 10-2 in particular is starting to uninvert. So again, it hasn't uninverted yet, but yeah. So the statement is always that the warning sign of a recession is the inversion of the yield curve. That just warns you that a recession is coming. The uninversion tells you it's arrived. And so we're starting to see the 10-year, 2-year uninvert, which tells us we're actually closer to the beginning of that recession than not. But again, everybody's saying that it's not going to occur. So
okay. So this is the question I'm sort of working up to here. So I put out this on Twitter the other day, and it really was an honest question. The market is predicting the Fed is going to be cutting rates starting by mid-year. Right. I think right now it's projecting the Fed's going to start cutting from a federal funds high of around 5, which is projecting where it's going to be around May, down to about 4.2% by the end of the year. And the trajectory continues downward into 2024. Right. So Powell has, basically said, look, there's pivoting is not even on my roadmap right now. Right. I'm gonna hike and then pause and hold it there for a long time. We've talked for a long time about how, the thing that's going to force him to pivot is going to be some systemic rescue he's just going to have to force to do. So if the market is confident at this point from its predictions that something is going to be so bad it's going to force Powell to pivot by summer, why is it in rally mode right now? Because it is highly likely not to be for bullish reasons at the time.
Right. So if you check your Twitter, I responded to you. And I said my response is, how do you spell relief? The old Rolex commercial, right? How do you spell relief? Liquidity. So, and I gave you 3 charts. One is our liquidity measure, which is the Fed funds balance sheet less the TGA account less reverse repo. And there's been a huge spike in that liquidity measure, and the market tracks that liquidity. So, despite the fact that we have all this other stuff going out there, the Federal Reserve has already reversed back into providing liquidity through 2 measures. One, is, of course, the expansion of the balance sheet. Now, that's not QE because those are loans to banks, but it is an expansion of the balance sheet. But number two, and a much bigger issue, was the opening of the dollar swap lines that they did to help bail out Credit Suisse and UBS and the whole European banking issue. So those are always the first steps. Whenever the Fed has opened dollar swap lines, the next thing to come is more liquidity. So, this all goes back to the article that I wrote called Pavlov's Experiment, which discusses Pavlov's experiment with the dogs, where he would ring the bell and they would start to salivate in anticipation of getting fed. Well, for 12 years now, we've been teaching investors the ringing of the bell means to buy stocks. And when you open those dollar swap lines and expand the balance sheet, most investors don't understand where the balance sheet comes from. They don't understand quantitative easing. They just know if it goes up, you buy stocks. And that's the ringing of the bell. So we've rung the bell. And what the markets are now expecting is more liquidity, and that means stocks go up.
Okay. So I guess first off, so the market's reaction is a very short-term one then, just I heard the bell, I'm salivating, right?
Exactly.
So, is this kind of the rush of the crowd into the building before it becomes the towering inferno that they're all stuck in, right? And I don't know, but I just want to go back and get your thoughts for a second on this. Like, if the market is expecting the Fed to be cutting rates this dramatically later this year, then kind of de facto or ipso facto, it means that something broke badly enough to force Powell to do that. So, I mean, let's fast forward to July and let's say that's true, right? Yeah. Powell says, oh my God, X has happened and I've got to abandon the plan I was super serious about to deal with this. Do you expect the market to be in rally mode in that type of environment?
Probably not initially, but look, two things are, I don't want to say the words this time is different because I'm not saying that, but there is a difference this time in this one fact. Previously in history, when the Fed was hiking interest rates, the market was still going up. And this is why you always hear a lot of statistics that are thrown. It's like, hey, whenever the Fed starts hiking rates, markets are up 20% over the succeeding year. And that's true. And when the Fed's hiking rates, markets are still going up. We talked about momentum in the markets. And of course, people are going, well, yeah, the reason the Fed's hiking rates is because the economic growth is still strong. They're just trying to slow it down a little bit. It's all good. When the Fed starts cutting rates, that's where you have the bear market, because that's where the Fed realizes, oh crap, I broke something.
Right.
I've got to cut rates. Now the market is trying to backpedal on all those expectations, and you have the decline in markets. Here's the difference. The Fed started hiking rates last year and the market declined 22% last year. So the market pre-declined in front of the Fed rate cuts. And that's different. That hasn't happened before. Going back to all the other previous rate hiking cycles, the decline occurred after the rate cut started, not before. So two things to think about here. And again, I don't have the answer, but here's the two things you have to consider. One, how much, let's say come June, the Fed starts cutting rates because the banking crisis reemerges.
Yeah.
Okay. Pick a topic, right?
Bigger banks. Let's say it's now the JP Morgans of the world that are in trouble.
It's not going to be, but
I know, but for the argument's sake.
Yeah. Okay. Well, I don't want anybody going out going, oh, Lance said JP Morgan's a fail. Big banks are fine. Don't worry about big banks. And, so that's a different story. Well, let's just say it's a recession, right? We just, we get into a recession this summer. Okay. Well, the problem is now investors are going to go, okay, well, here's the recession. We all knew it was coming. That was clearly obvious. We've already reduced the market value by 20% on the broad margin, but look, a lot of stocks in the index are down 60, 70, 80% from their peaks, right? So we took a whole lot of that bear market and front loaded it. So could the market rally even as the Fed starts cutting rates to solve some economic or financial crisis? Yeah, because the market's already built in a lot of the expectation for that event. They preloaded it basically. So yeah, the market could go down. If it's an event that occurs quickly, like we wake up tomorrow morning and 5 banks have failed, the market's going to go down. and the Fed's going to step in, they're going to cut rates, they're going to supply a liquidity line, the market might decline 5 to 10% somewhere in there. And then the market's going to stop because they're going to realize that's already been priced in. Here comes the liquidity. Now I've got to start buying stocks. So there is a very high probability the October lows were the low of this cycle. And so I think that's one thing you've got to kind of keep in mind. A lot of people keep expecting we're having this another major leg down on the bear market. It's possible. I'm not saying it is not possible. I'm not even saying it's not probable. I'm just saying that there is a real possibility here that October was low. You're starting to establish a lot of very bullish trends to the markets, the 50-day above the 200-day moving average, the 200-month moving average, and the 200-week moving average held support. So technically, that correction last year was just that. It was just a correction back to the long-term bullish trend that started in 2009. We bounced off that nicely. And the market should, theoretically, if this secular bull trend is going to continue, we'll hit new highs by next year.
Okay. Appreciate that. I'm curious, if last October's were the lows, would that surprise you? And I ask that both for sort of your macro outlook, but also just, we did not see the capitulation that one tends to sort of see at the bottom of a bear market. And you would say, hey, that we may not have been in a bear market. It might have just been a downward correction in an otherwise uptrend, right?
Yeah. No. So first of all, look, if we retest October lows, it won't surprise me at all. If we don't test them, right, and this market keeps going higher, that won't surprise me either. A lot of it's just going to depend on what market's doing right now. Since October, the market's been way more bullish than the headlines, right? I mean, we've talked about all these other issues and headlines and all the YouTube podcasts everywhere and the news media and you name it everywhere. So it's like recession's coming, the world's ending, and markets have been grinding higher since October. Yep. Market's really just ignoring all the talk and going, right, hey, focus on what's happening here, right?
Which is what a bull rally does, right? Or bull market, right? Which is it climbs a wall of worry, right? There's been a lot of worry and it's been climbing. Yep. Can't deny that.
And it doesn't mean that it can't continue. And this is the big challenge of managing money, right? And we talked about this before. It's like, this is doing something that logically doesn't make sense to me. Logically, I look at all my economic data. It says, just as we just talked about, right? All my indicators say we're having a recession. Logic says we should have a recession because the Fed's hiking rates. We're extracting liquidity from the economy. The consumer's highly indebted. They're slowing down. I mean, I can't make an argument of how to not get in a recession at this point. That's the big challenge. And then on the other side of this coin is markets just grinding its way higher. And look, I do expect the markets to pull back decently, probably this summer. And we will know then whether or not that we're in a more serious next leg of the bear market decline, or if it's just a buying opportunity. But we'll know when we start to get there. We're just not there yet.
So, okay. So I want to put up the chart, one of your charts there about liquidity. Yeah. That shows that we saw this big jump in the liquidity index recently, right?
Yep.
If you put a chart of liquidity next to the S&P over a long period of time, I mean, the correlation is ridiculous, right? And I've had lots of discussions with a number of the folks that come on this program, which is like, are we just overanalyzing this? Like, should we just basically look at liquidity and that's telling us where things are going, right? And it's hard to kind of argue with that. So, your point is, hey, look, liquidity in this environment, increased starting around October, and lo and behold, we're off the October lows, and the market's been resilient since, right? Right. Here, I want to ask you this about a potential coming liquidity crunch, and I got a couple different things here I want to just mention, and you can react to them. Yep. One, here's a chart of M2. Right, money supply is measured by M2, showing that it is contracted by the most it's contracting by the most on record right now, right? All right, moving on from that, the Fed is still hiking. It's still hiking and tightening, right? Hiking. Maybe that's what we can call when you munge rate hikes and QT together, right? But both of those are still in play. The Fed has, Jerome Powell was telling us, he said, hey, in addition to my efforts, the banks are now going to be tightening lending standards even further based upon these banking issues that we've been having. Right. And then last, I mentioned this when we talked, I think last week, at some point when the debt ceiling is raised, which I think everybody has a high confidence it will be at some point, Janet Yellen's going to need to refill the TGA. And I know I asked you about this last week and you were like, it's not big enough to matter. And maybe that's the case, maybe it's not. I was talking with Lynn Alden about this, who actually said it's a pretty big deal. I mean, it's hundreds of billions of dollars that will be not going into the economy, that's being pumped out by the TGA right now. And then people, with the Treasury then having to sell treasuries, capital is going to be coming in to buy them that might otherwise go elsewhere for investment too. So she said that might actually trigger a short-term liquidity crunch. So you take kind of all those four things I just mentioned together, you can come up with an argument that liquidity might actually start tightening later this year. Maybe it is what causes the dip by summer. I don't know, but I'm just curious. What do you think about the potential for this surge in liquidity we're seeing right now to kind of get undone by some of this stuff?
Yeah, I know. Look, when you start, starting to have to kind of calibrate things, and again, and Lynn's right, is that one, and we talked about this before, is that one of the big fears is that, oh my gosh, we're taking all this money out of federal pensions and they're not going to have their money. That all gets repaid, right? So as soon as we get the debt ceiling raised, anything that was borrowed in order, and that's what these emergency measures are. Basically, they're borrowing from other pockets of money within the government. They issue new debt that repays all that. So it all gets put back to where it was. So there's no big fear over that. But it does mean that we have to issue more treasuries. But see, right now, that's not really a problem because we've got people buying treasuries hand over fist. How many people have you told on this show to go buy 5% year treasuries, right? And these are all short-term debt that gets put out there. These aren't 30-year bonds or necessarily, a lot of this is short-term treasury.
I would say Wealthion's responsible for like 80% of all T-bills sold in America.
I would agree with you. But no, I mean, even with us, right? We have we are regularly buying T-bills and putting cash to work. And there's $5.2 trillion in money markets right now. By the way, that is not money on the sidelines, but there's $5.2 trillion in money markets right now. That's all short-term treasury bonds, right? So there is plenty of demand to buy bonds. So yeah, there may be a short-term reduction in the amount of liquidity in the markets or in the liquidity measures. But if that occurs, very likely this is going to coincide with some other event within the markets, either whether it's a banking issue or whether it's a credit issue or whether it's an economic issue, that the Fed is now coming in and supplying liquidity on some other side of the ledger, either through expansion of their balance sheet or through some other, increasing reserve repo lines or whatever it is. Just like we just did with the deposit windows, right? For a lot of these small banks to get plenty of capital from. So, there is going to be an offset. So the question is whether or not the amount of liquidity increases and how dramatically does it increase or decrease? And the market will follow that one direction or the other. So if we do get a reduction in liquidity, markets will decline until that begins to reverse.
Okay. All right. Well, I just wanted to flag that out there for folks. Yeah. Okay. So, if it does start happening, obviously we'll be tracking it on this channel and reporting back to folks.
Yeah. But I think this is key to something you said just a second ago, by the way, which is, is liquidity all that matters? And unfortunately, yeah, it's all that matters now, because this is what we've trained markets to do. Fundamentals don't matter. What are the worst performing stocks this year? Fundamentally strong ones, right? Which are the ones that are best performing? Fundamentally the most expensive ones. So we don't invest on fundamentals anymore. We don't invest on economics anymore. We don't invest in those things. We just simply are looking at what the Fed's going to do, or what are they doing, and which direction is liquidity going. That's how simple the equation has got. And if you're worried about all this other stuff over there, and you're not paying attention to those factors, you're kind of missing what's driving the markets.
Yeah. All right. Well, look, we'll be keeping a close eye on these liquidity gauges as we go forward from here, folks. And you know, I'm trying not to fall back into the rant pit of this Frankenstein that the Fed created, right? Because it is a Pavlovian response.
Yeah, you and I are both in the pit. I don't like it. It just is what it is.
Yeah. All right. Well, look, I want to grab the conversation into a totally different topic, which is just one that's in the headlines right now. I just recorded a video on this a few hours ago on de-dollarization. Real quick before we get there, Lance, is there anything else about the current market action we haven't talked about yet that you think is worthy of people knowing?
Yeah, look, just let's boil it down to the simplest factor right now, which is, look, our job as investors is to make money. That's it. We've talked about before, you know, trying to avoid the next downturn or bear market will lose you more money than the downturn or the market downturn itself, right? Just focus on what the markets are doing right now, and we'll keep you updated. So as things begin to change, we'll say, hey, look, our indicators are very overbought. We're taking money off the table. So go take some money off the table. Right now, you can put some money to work, but just do so cautiously. We're not 100% exposed to equities right now. We just modestly increase our equity exposure to take advantage of this rally, and then we'll reduce it when this rally is over. I don't know, and nor does anybody else know what this market's going to do, much less next week than 6 months from now. So,
right.
You know, it just, you know, all this other conversation, it's great for headlines. It's great for getting clicks and views and all that. Look, I write articles about recession this and recession that. It's great views, right? But the reality is when it comes down to managing money, it's important to understand these things and what the impact could be. But we also need to respond to what the markets are doing and participate accordingly, and just do so safely.
Great. And you're reminding me in that answer that we've really pretty heavily focused on equities in the conversation so far. And of course, with bonds, we've been talking about, you know, the fact that we may be getting near the end of the rate hike cycle. I think when I asked you this, you said the peak in yields is highly likely in. Yeah. And so just, do you have an update in terms of what you guys are doing with the bond side of your portfolio right now?
Yeah, so just before the, like 4 or 5 days before the FOMC meeting, I told you that we had increased our bond exposure. Bonds ran up at that point. That was when the banking crisis, right after that, we had the banking crisis, yields fell pretty sharply. Unfortunately, those yields fell so sharply that bonds got very overbought short-term very fast because of that very sharp drop. So now we're just kind of letting that work off a bit. So we'll probably be adding more to our bond portfolio, but we need to see yields come up a little bit and bond prices come down. We're getting pretty close to an entry point. I won't be surprised by next week when we talk if we're not adding more bonds.
Oh, really? So you think that could come that quickly then?
Yeah, well, I don't know. Again, it'll depend on what the market does. It could be a week or 2 or 3. So, you know, but it just depends on how fast prices or yields move over the next 2 weeks. So, and that'll be a negative correlation to what if the market, in other words, if stocks rally. So here's all you need to know about stocks and bonds. If stocks rally, that's a risk on event, right? So that sucks money out of safety. So everybody that ran over there to money market or to one-year treasury bills are seeing the market run up and going, oh crap, I did the wrong thing again. So they sell those and go buy stocks, generally right at the top.
Right.
So you get that risk on to risk off trade. So as the market goes up, it's going to suck money out of bonds. That's going to push yields higher. And then when stocks get very overbought and get ready to give us a sell signal, that'll probably be the time we want to be buying bonds again.
Okay.
Yeah.
All right.
Because
great.
it'll be risk off. It'll be risk on, back to risk off.
Back to risk off. And okay, so that's sort of bonds generally. Of course, we've been talking a lot too about duration of bonds, right? And you were more short-term loaded. You were beginning to extend a little bit. I think I asked you last week, did we sort of miss the opportunity to buy more out long? And you had said no, but you were going to potentially wait for a bit of a correction before you continued adding long. Is that still true?
Yeah. And we did get a little bit of a correction, not enough yet. But no, you have not missed the peak in rate. I mean, look, I think the peak in rates is probably behind us. But you still have plenty of opportunity to buy bonds, because if we look, and if we get into a recession, if all of our indicators are right and we do have a recession, yields are going to go to sub 1% on the 10-year treasury. So there is a lot of capital appreciation still to be made in bonds. You haven't missed that train ride at all.
Great. All right. And just to remind folks too, let's see, what's the 10-year yielding right now? It's like 3.6.
It's like 3.55. I can't see my computer from here. It's too far away and I'm too old.
Okay, but around 3.6, and you're saying it could go sub 1. And what's nice about that, just a flag for folks, right? Not recommending this necessarily as a trade, but you can put some money in the 10-year and get paid 3.6% to sit there no matter what happens. And then if Lance is correct, or if the market predictions that I shared earlier are correct about the Fed pivoting and beginning to bring rates down, you're still going to get paid, but the price of your bond could appreciate pretty nicely. I mean, if we went to sub 1, it would appreciate an awful lot, right?
Yeah. Well, and if you're going, there's no way the market could go sub 1. Don't forget, in March of 2020, we went to half a basis point on the 10-year Treasury. So yeah, it can get there. And it wouldn't even surprise me to see if we get into a really bad recession and the Fed's really starting to cut rates hard, that the yield could go literally to 0 on 10-year Treasuries. That would not be outside the realm of possibility. So if you think about that relative to the decline in yields versus the price in bonds, there's 40 to 60% upside on 10-year Treasuries.
Yeah. And look, that's not a guarantee, but the fact that it's in the realm of the possible, like you don't, it's not a fantastical thing that could happen. You've said, we've seen parts in relatively recent history where we've seen even greater changes in the interest rate. And the fact that you can get paid to take that not crazy gamble. Yeah. I mean, you don't get too many opportunities like that in investing, correct?
Well, so let's analyze that trade for just a second. So here's your choice. You have $100,000 and I say, what are you going to do with it? You only have 2 choices, Adam. You can either put 100% into stocks. You can't do one or the other. You have to either choose 100% stocks or 100% 10-year Treasuries. And you go, well, I think we're going to have this terrible recession, so I don't want to be in stocks because I could lose half my money. It's a fair call. Nothing wrong with that call. So you say, okay, I'm going to put 100% into bonds. What's my upside? What's my downside? Upside is that yields wind up falling towards 1% over the course of the next 12 months. When you get down to that level, the price of the bond will have appreciated markedly, again, 30, 40%. You'll want to sell all your treasuries at that point. You don't want to hold them because you've milked out all of the price appreciation of the bond.
Right.
And at that point, stocks are going to be very cheap. So I will end with a high yield. So I'm now going to move from my 10-year trade. I'm going to take my $100,000 is now 140 and go buy equities with it at dirt cheap prices. I'm totally wrong though. And the economy doesn't have a recession. The stock market takes off. And here you are sitting on your poor little 10-year bond yielding 3.5% for the next 10 years. In 10 years, you're going to get all your money back plus 3.5%. It ain't a great return, but it's not a sharp stick in the eye either.
Right. It's not like a catastrophic loss the way that equities could be if you get the equity story wrong, right? Yeah, look, folks, I'm not making this is not a guaranteed trade, not saying everybody should run and do this, but I'm just saying you don't get kind of a not so bad downside, really pretty good upside trade-off the way that you have right now for the next 12 months, right?
Yeah, and again, this is why I've been buying more and more treasuries for myself personally, just because it's a fairly obvious trade that if the Fed is going to start cutting rates, yields are going to come down. There's just no way around it.
Okay. All righty. Well, now moving on to this topic of de-dollarization, and we don't need to spend a huge amount of time on it because, like I said, I just recorded and we did it live, so it's already available for folks to watch. Did an interview with John Rubino on this topic, and I'll put up a link to it right here for those that want to watch it after this. But this has been all of a sudden kind of everywhere in the news. I found it ironic that there was an article that came out yesterday that said it was about this topic, but it had a segment that CNN did in it and a segment that Fox News did in it, right? So you've got sort of the polar ideological ends of the media spectrum are all embracing the story again suddenly. And it's basically, first off, folks, this is a process that has been going on for a long time, for decades. The central banks around the world have been slowly weaning themselves off of or slowly decreasing the percentage of dollars that they hold in reserve. It's still a very high amount. I'm doing these numbers from memory here, but I think it's something that was like, 20 years ago, it was in the 70%, and now it's down to like 59% of world reserves, right? But what's happened, relatively recently, past couple of days and weeks, there's been a number of announcements by, big countries, China, Russia, India, Brazil, Mexico, Saudi Arabia, that they are entering into, trade agreements that have always been settled in dollars, and are now settling those in other currencies besides dollars. We've seen, certainly since the invasion of Ukraine, where the US basically weaponized its financial system against Russia, we've seen a number of central banks, foreign central banks, accelerate their, the amount of dollars, the decreasing in the amount of dollars that they hold in their on reserve. And so, we're basically, we've been seeing this understandable acceleration, since America's response to Russia, because obviously a lot of these other countries are saying, hey, I've got maybe decent relationships with America today, but that might not always be the case. And I see what they're doing to their enemies now. I don't want to be so exposed to a tactic like that. So, we've kind of given the world this catalyst to try to, start doing trade and things other than the dollar. So Lance, I'll let you comment on this as to whether how big of an issue you think it is. I'll just underscore the really big issue, I think that most folks, or concern that most folks have around this, is the fact that the Saudis are really beginning to strike deals for oil, not in dollars. And probably the greatest privilege that the US dollar has enjoyed for the past 50 years is its status as the petrodollar. And if that gets broken, there's a lot of people, including the Fox News segment had the former Assistant Treasury Secretary on. She used words like catastrophic. I don't want to, I don't want to be too inflammatory here, but there's certainly officials out there that think if that were to really truly indeed happen, that the implications could be quite severe. So, anyways, Lance, I'm curious. Yeah, everybody's spun up on this right now. Are they spun up for good reasons, or is this not a big deal?
It's not a big deal. And it's great. Like I said earlier, this is one of those topics that keeps running around. It's like great for headlines, right? You got everybody to view, and everybody's like watching videos now for people's like, oh, the dollar is going away, so we're lose reserve currency status. Okay, let's go to the very basics of how the world works. Okay, so first of all, let's just talk about why the world has 59% of their money in US dollar reserves. It is because it is the reserve currency. So where are those reserves held? They're held in US dollars. So let's take everything off the table and let's just talk about countries at all and saying, okay, I need to execute trade on a worldwide basis, and I need a place to have a common exchange currency to do these transactions. Right now, that's the dollar. So 59% of the world's currency is stored in US dollars in those reserves, right? So that's what we talk about reserve currency. So let's take the US. So let's assume that all these headlines are right and the reserve currency status goes away tomorrow. Okay. Now your choice is, as every other country, including the US, we now have to all figure out which currency we're going to use as the reserve currency to execute trades. So there's a couple of things that have to happen to allow that to occur. So first of all, the currency has to be deep enough and large enough to handle trillions of dollars of transactions every year. So everything that you buy and sell, commodities, products, services, goods, anything else, that currency's got to be very deep. The second thing is it's also got to have a relative, what we call full faith and credit backing to it. So no matter what happens, that currency is going to be valid, it's going to be there, and there's a structure behind it to allow claims to be made, so that if I'm selling a product to Adam's in Germany and I'm in the US, I sell Adam a product and he defaults on his delivery, I have an ability through recourse of some legal manner to go get my money from Adam, right? So got to have some type of legal structure foundation behind the full faith and credit that the currency is going to be made whole at some point. And then, of course, lastly, there's got to just be a safety factor. So, in other words, let's say we're all going to pick China and we're all going to use the yuan as the reserve currency. Do you really trust the Chinese government not to just wake up one day and go, yeah, we're sitting on $50 trillion worth of currency. Yeah, we're just going to keep it. So, when you start talking about, World War III and these type of things, World War III is not going to be fought, on the ground with tanks and planes. It's going to be financial. It's going to be economic. It's going to be cyber. It's going to be all these things that are going to happen. So would you really trust China as a country of store of value for a reserve currency? I'm not saying that, I'm not giving you the answer. I'm not saying yes or no. I just want you to think about this process of the reserve currency. So this is why, yes. And now there's a couple other things that are going on that's causing this other, transactions to occur. What's the big problem right now that France has, as an example, with LNG? Well, they can't get LNG from Russia for a couple of reasons. One, Russia won't send it to them, but there's also sanctions. We can't buy stuff from Russia. And at the same time, so that caused the price of LNG to go up, right? So LNG got much more expensive. Now, if I've got to buy that in dollars and the dollar was very strong, which it has been, I now have to pay this exchange rate, which means that LNG is even more expensive. So not only do I have inflation in all these products, I also have to deal with the currency exchange ratio that is not favorable, that's making these products even more expensive than they were just on an inflation adjusted basis. So the logical thing to do would be to cut a deal. And this is why only 59, and even at the height when we were at 70-something% of reserves, there's still other transactions that are going on in the world in other currencies. Otherwise, we'd have 100% of the reserves, right? So this is just a workaround for these countries to say, look, I need to offset this dollar exchange strength. When that reverses, these transactions will all go back to dollars because it'll then be in their benefit because they get more value for. So in other words, if the French franc is stronger than the US dollar, they'll go, let's do it in US dollars because now I really get a bang for my buck. I get more product for less money because of the exchange rate. So, these things make a lot of headlines and will US reserve lose reserve currency status at some point? Maybe. It might be a couple hundred years from now, but it's not going to be in our lifetime, right? It's just, so again, this goes back to be careful. And look, I don't care what your view is. If your view is we're going to lose reserve currency status tomorrow and this is all going to hell in a handbasket, cool, right? I'm not saying whether your view is right or wrong. I'm just saying from an investment standpoint, this is something that is not going to affect the markets in the near term. And something that if we do see it coming, if all of a sudden we wake up in 5 years from now, we're down to 20% reserve status, we might have more to talk about, right? But we're not anywhere close to that right now. So again, focus on what's important near term, and we'll just keep a watch on these bigger issues. And if they become an issue, we'll deal with it.
Okay, yeah. And I think the key thing out of this is, I think there's probably, and this is just one guy's opinion, right? I mean, I think there is some real movement on geopolitically to say, hey, look, the US has been calling the shots for a long time and can be pretty heavy-handed at times. And a lot of the countries that are doing this are countries that, aren't necessarily America's best buddies, right? So there's a little bit of a coalition of the like, hey, we should probably do this as a hedge.
But Adam, think about it, right? So China, Russia, India, Pakistan, Middle East, we have, what have we done as the US, right? We're imposing sanctions on these people. We've invaded these people, they're not our friends. They're not our allies. So of course they're going to figure out some way to trade outside of the dollar because if they try to use the dollar, they can't because we sanction them and freeze their assets and do all other kind of stuff. So sure, they're going to find other ways to do stuff. And that's not surprising, but the question is going to ultimately be, is the whole world going to go in that direction?
Oh, yeah, no, totally. And that's where I'm going, which is, and most importantly, what I'm going is even if it's going in that direction, like, let's just say that is, and we lose the world currency status and reserve currency status and all that stuff, it's not going to happen tomorrow. It's going to be a process. And I'm trying to avoid people calling you, Lance, and New Harbor, after they watch this and say, oh my God, get me in 100% non-dollar denominated assets, right? It's not, the fuse isn't that short here.
Right. Let me give you a good example. I got an email from one of your viewers this week, right? So really nice guy wrote me an email. He says, I need to get out of the US dollar because I heard that, this is all going bad. And so he's like, I've got investable assets. So what I'm thinking about doing is I'm going to put, X amount of money in US real estate. I'm going to put X amount of money in foreign real estate. And then I'm going to move to Puerto Rico and, I'll put the rest in stocks. I go, you have not solved your dollar problem.
Right.
Because
and still living in a U.S. territory that operates in dollars, but okay, I won't think about that.
Yeah. That's what I'm saying. So, buy U.S. real estate, you got to do that in U.S. dollars. That's fine. Now you got an income producing property, and I don't have any problem buying real estate. So that's good, but it's done in U.S. dollars. Buying foreign real estate, okay, great. You do a currency conversion because that's the way to look. Just can we take one step back here real quick? This is important to understand. Dollars never leave the borders of the United States. When you buy something overseas or you make any other purchase anywhere else in the world, US dollar never leaves the border of the United States. This is why China buys so much in our treasuries every year, is because they're sanitizing transactions. We buy 50 billion a quarter, whatever it is, from China. If China took all those sales back into yuan, the strength of the yuan would rise dramatically relative to the dollar. And that's not economically advantageous for them on a trade basis. So what they do is, instead of taking those dollars back into yuan, they buy treasuries with it. And that's what we call sanitizing trades. Mm-hmm. And so they sanitize those transactions. And so back to our real estate issue. Now I buy real estate in a foreign country. I do get my money out of the dollar that way, but I buy property that doesn't appreciate near what you get in the United States. So I've kind of got an asset that isn't going to really do anything other than maybe generate some Airbnb income if I lease it out, right? Mm-hmm. So, I'm not going to pick up that price appreciation that you would have in the United States with that real estate.
Right,
So,
and you get some diversification, which is good, but then you also get additional country risk, right? Where
correct. And then, of course, you're investing in stocks that's in dollars. So, this is, there's a lot of talk about, I get a lot of emails from people like, I need to get out of the dollar. You don't, because the dollar is still the dominant currency. And at some point, if you do need to get out of the dollar, the question is where are you going to go? Then that's going to be the real issue, because there are plenty of times in history where countries have gone, yeah, we're just going to take that asset. I had an investment in Malaysia back in the late 90s. And the Malaysian government said, yeah, we're just taking that.
We're just taking it. Yeah.
Yeah, that's it. And so, there was no recourse from that either. So those are the things you have to, and this is why we've talked about on the show more than once, the rule of law. The rule of law is so incredibly important to the strength of an economy. And unfortunately, our political divide that we've got going on right now is destroying that rule of law. But that is the one thing that drives economic wealth and prosperity over time.
Right. And even though we can make a lot of criticisms about the rule of law in America, it is still in most cases sort of like a best horse in the glue factory type of issue, where a lot of these countries we're talking about, the rule of law there, it's just night and day compared to where we are in America, night and day worse, right? So there's a lot of things I want to tie up here before we move on, which is, look, all these things can happen at once. Right. So what I mean by that, it probably, I think it's probably probable, I think it is, that this de-dollarization trend is going to continue. Again, it doesn't mean that we're going to lose world reserve currency status overnight, but what will probably happen over time is more and more trade will be done in other currencies, and there will just be more competition, right? But I think that means there will be less demand for dollars as we go through this. And of course, nothing happens in a straight line, as you said, Lance. There may be times where, all of a sudden everybody wants the dollar again for a period of time. But, and especially if the petrodollar really begins to break, right? What it does mean is we as Americans have enjoyed a massive advantage, which I don't think we can deny, by the setting up of the current monetary regime with the dominance of the dollar and the petrodollar and all that stuff. And if that erodes, we just need to be cautious about what that could mean, right? And that will likely mean more inflation for a variety of reasons, weakening dollar, but also if indeed these BRICS countries continue to strike more of these types of deals, and Zoltan Poznar over at Credit Suisse has been writing about this for a lot. He says, look, more and more commodities, right? A lot of the countries that are banding together in the BRICS are the commodity producers. And he says more and more global commodities, may not be priced in dollars going forward. And look, a dollar will always buy something, right? But he said just the supply of them is getting increasingly encumbered by these other countries, right? So, 30 years ago, there wasn't a ton of purchasing demand out of China, right? It's night and day now, right? Where they're driving Teslas in China and want same lifestyle that we in the West have, right? So, those countries have grown, to a size now where their economic clout, especially collectively, is pretty darn big. And so we may, as America, want to go buy commodities the way we always have, and they'll say, great, we'll sell them to you, but just so you know, we might not be able to sell you all you want because we've already guaranteed this supply, to this part of the world, right? So we just got to be aware that these may be the dynamics going forward. And yeah, maybe that creates opportunities for assets that are commodity driven or because there's more demand, competition for them, or for hard assets versus the dollar because they'll hold purchasing power better than dollars might, over the arc of what's coming from here. But I do want to end this with your point there on rule of law, Lance. So Michael Every, who's been writing about this recently, it's interesting because he's actually worked in China a lot and he grew up in Russia. So he has real firsthand experience in these countries. And he likes to kind of remind people that they're, whether you think they're evil geniuses or whatever, he's like, I've been to these places. Like they just don't have the capacity to, sort of emerge as the dominating winners that sometimes when we get nervous in the West, we think they could be. I remember a couple of years ago, we all thought we were going to working for our Chinese overlords, right? Yeah. He just said they just have really structural problems, internally that are real and kind of big, right? So kind of to your point, Lance, about like, who do you want to trust? He's like, really, for these regimes to like really knock the US dollar off its world currency platform pedestal. He said, you got to get to the point where people are willing to retire in China and store their money in Russia.
Yep.
Right. And when you think about it that way, you're like, okay, yeah, I don't know a lot of people who are psyched to do either of those. Right.
No, that's exactly right. And like I said, and then you go outside of China and Russia, then you start getting into Brazil and Argentina, and those currencies are just not big enough, deep enough to handle transactions.
Right. And those currencies have histories of just dying every 10 years, right?
Exactly. And so again, look, here's the point about all this is like, again, I don't care what you want to believe. If you think the world's going to end on the reserve currency status, that's fine. You can invest accordingly. Just realize that and Adam may be very right that this will eventually occur, but it might be 30 years from now. I'm probably not going to be around in 30 years or 40 years or 50 years. These things take a very, very long time for these things to occur, unless you get into a massive world war. Then things can change very quickly. But at that point, none of this is going to matter.
Right. And for folks worried about that, just to preview, I had a really great discussion with Matt Peipenberg of Matterhorn Asset Management this week that's going to air next week. And that's sort of where he takes it is sort of like, we weren't talking about de-dollarization specifically, but just sort of all the macro trends. And he's a big student of history. And he said, yeah, what you got to watch out for is currency destruction, inflation, and war. And if that's an exploration that you're interested in having, folks, keep your eye out for that video. All right, well, look, so I want to go on from here, and it's going to sound, I'm going to warn folks, it's going to sound like I'm just taking cheap punches at America here. I'm not, but what I'm trying to do is sort of make the point here that we have enjoyed a lot of advantages that the rest of the world has allowed us to have, and we may be going into a period where we're losing some of those advantages, or maybe we didn't necessarily deserve, or maybe our current behavior isn't deserving of them. And we're seeing an erosion of things that I think we just take for granted with the concept of American exceptionalism. So I want to dial through a couple of things here, Lance, and just get your response to them. Again, this is not to crap on America, but it's just to say, hey, we as Americans, we got to be the eagle. we may love our country, we may love our culture, but we got to be just realistic and eyes wide open and honest about what's going on, right? So we've got the de-dollarization that may be building steam from here. Real quick, I want to dial through a few things. One, U.S. spends more on healthcare than nearly every other country, right? We've heard this, yet it has the lowest life expectancy of the OECD countries, right? So when it comes to, spending money and keeping people healthy and alive, we don't have the best system out there. And we just got to be honest about this. It's crazy expensive. And you look at the stats, we're not the healthiest for what we spend.
That's not really a true statement in terms of, yes, expensive, yes, because we pay for all the R&D that we don't provide to other people, but also there is a vast difference between the quality of healthcare that you get in the United States versus other countries. I've lived in other countries, and yes, you get healthcare there, which is you pay through your taxes. It's free, it's cheap. It's not great. In fact, most people that live in other countries, there is a private healthcare system that they pay for out of pocket, which is much better healthcare. Or they come here to the United States to get treated. If you've got cancer, there's only one place you go.
Don't disagree that we have the best healthcare here. It's just not evenly distributed.
No, it is. If you want healthcare anywhere in the country, you get it. You get it for free. You just have to walk into an emergency room. You can't pay for it. You're going to get treated. That is the bottom line. That you get healthcare. The reason healthcare is more expensive is because we pay for those people that are getting free healthcare. So right. Somebody's going to pay the tab somewhere, but you're going to get healthcare and you're going to get good quality healthcare, period. The reason our life expectancy sucks is because we have the world's worst diet. We don't exercise. We have the worst food on the planet. It's all high in fat, high in sodium, high in potassium, and we don't exercise. We are one of the most obese countries on the planet. Every other country that I've lived in, you eat very healthy. Most of the food is right off the ground. When I lived in Spain, all the food came right from the farms to the market. You walked to the market, you bought your food there, took it home, you cooked it. It was clean, it was healthy. And they walk everywhere. Every night they're walking, they're drinking wine, they're walking somewhere. Same way when I lived in France, same way when I lived in Germany, same way when I lived in Switzerland. There's a very big difference between the quality of the food that you eat in other countries and how you eat in other countries versus how we eat in the US. So you can't blame the healthcare system for lower life expectancy without blaming the diet and exercise of Americans themselves. And again, we got all these kids sitting around playing video games all day, not going out and exercising. That's why we have the highest obesity rate of teens on the planet. And that's a terrible statement to make. The military can't even recruit people because they can't pass the physical fitness test to get into the military. So it's just a terrible statement to make all around.
Well, you're preaching to the choir, and we have ranted about this before, so I won't repeat it here. I will note that the biggest reason for why our longevity is lower than these other countries is we have more younger people that die, which surprised me when I saw that. And I don't know if it's from obesity or if it's from violence or whatever, but it's that our younger population is dragging that longevity down. That being said, though, I agree 1,000% with the fact that we have, and just to sort of tie it back to the medical industry, I'm from a family of doctors and nurses. Every one of my family members that's gone to medical school were given 0 classes in nutrition. Going through there, right? It's just still not part of the
right. And you talk about, yes, we do have a lot of deaths of our younger generation, but let's look at that, right? So first of all, they are obese in a lot of cases. They don't eat well, they don't exercise. But we now give them pills for everything, right? I'm sorry, you're not happy, here's a pill. You're a little stressed out, here's a pill. You can't sit still, here's a pill. Can't focus on your study, here's a pill. If we went back to the way I grew up, which was, I'm sorry, you can't sit still, here's a smack upside the head. You can't, here's a smack upside the head. Get outside and play and drink out of the garden hose, because that is your antibody for everything. You never get sick once you drink from a garden hose and survive that little trend. So, this is part of society that we've bred over the last decade. And yeah, our mortality rates are going up, our fertility rates are going down.
We've got these addictions, fentanyl, all that stuff, right? These epidemics.
And look, even we had this whole vaccine rollout, and now there's all kinds of data coming out on that as well. So, whatever the end result of all this is, I think you can always point it back to the fact that if we just took a breather here for a minute and started talking to people about better education, better health, better diets, exercising, look, and we're not talking about going to the gym and sweating it out for an hour and a half or getting on Adam's bike for an hour and, posting videos of your accomplishments. That's just rude. But I'm just talking about taking a 30-minute walk with your spouse. If you want to do one of the best things for your marriage, have dinner with your wife, go on a 30-minute walk with her, hold her hand and talk to her. If you want the best return on your investment outside of anything else, that'll do it for you. You'll get improved health, and I guarantee you'll have a much better relationship.
All right. Well, hallelujah. I totally agree with that. You're treating this as a rant, which I guess you can, but it wasn't intended to be one. But okay.
I'll stop
Good
ranting.
points. Good points. But basically, being the Eagle, we spend more than other countries on healthcare, and we're living less, right?
Yes.
Okay.
Not sure there's a correlation, but okay.
Education, not that great either, right?
No.
We're middle at the pack at best in education, and we spend way more on it, right?
Right. Okay, so let's talk about that, cause and causality, right? So China spends 2% to 3% on housing and about 15% on education. The United States spends 25% on housing or more and about 2% on education. We stopped teaching our kids. My wife and I just had this conversation last night, right? Because we've got 3 kids in college and high school and one that's out. Our kids were not taught how to critically think. They were taught how to take a test. And this has become a big problem since 1980, when the Department of Education took over the school systems. Prior to 1980, schools were run by states. After 1980, the Department of Education took over, and the quality of education has fallen, and our standing in the world in terms of mathematics, science, et cetera, have fallen dramatically. We used to be in the top 3, 4. Now we're behind Estonia on education of math and sciences and these type of things. And the big problem is, and I saw this with my kids coming up, and this is why I hired all my kids' tutors, is because the teachers in school are instructed to teach, and I don't know what it is in every state, so I'm just going to talk about Texas for a second. But in Texas, we have what's called a STAR test. And the teachers during the school season teach the kids how to pass the STAR test. That's it. And so we no longer teach kids how to read, how to write. My kids are bringing home the Mockingbird. What was the movie? I can't think of the name of the movie. There's a trilogy of movies about a girl with a bow and arrow. I'll think of it in a second.
Oh, The Hunger Games. The
Hunger Games. Thank you. I appreciate you. That's what my kids are bringing home to read in English, not bringing home, Chaucer or Shakespeare or Tennyson.
Well, when you said a Mockingbird, I thought you meant To Kill a Mockingbird by Harper Lee, one of the great American novels.
Yeah,
right?
no, see, that's what they should be reading, right?
Yeah.
But we don't. Our kids aren't being taught the way that we were taught, and we're trying to come up with all these new ideas. And now math is racist, so we've got to dumb down the way we do math and all these type of things. We're getting rid of entrance exams for colleges because those aren't fair to everybody. We're trying to, by trying to make things easier for everybody to succeed, you're lowering the quality of the education that they're receiving. And then we're all upset as to find, well, we're paying for all this education and we got stupider kids. There's a correlation. It's not the money we spend, it's what is being taught from that money that's being spent. And you're not getting a good product for what you're paying for. And that's what we need to start revisiting, is how to educate our kids to be smarter. I'm spending all my time teaching my kids. I pay school taxes. They're basically, when my kids were in high school and intermediate school, they were babysitters. Well, so I could go to work. And when I came home at night, I had to teach my kids things, right? Mm-hmm. So, that's not the way it should be. I had to teach my kids history and math and English and all these type of things that they should have learned in school, but they weren't taught these things in school. So, and that's the frustrating part for me as a parent.
All right. So I'm sure there's a lot of people who are, saying, you go, Lance, they're feeling that same pain as you. I agree with everything you said. As it comes to financial education, I know we've had folks, ask in the past, hey, it'd be great if Wealthion and Lance's firm, did a webinar on helping raise, financially well-educated kids, because our school system does not teach financial literacy. That's like a core reason why I founded Wealthion, right?
Yeah, big zero.
Yeah. So anyways, folks, if that's something that folks are still interested in, let us know in the comment section below. If interest is still high, we'll bump that up on the priority list here. All right. So I'm going to move on here because you're making it really hard for me to slug through these points quickly.
All right. I'll just shut up. You just go through your points. You just
no, this next one, I'm actually going to want you to chime in on. And then I'm getting to my main parting point on this whole theme. But Cracker Barrel just announced that they are leaving Portland. They're shutting their stores down and they're just leaving Portland. They're saying it's just not a good place to do business anymore. Walmart made the same decision before them, right? So we have a major American city that basically, major commercial operators are saying it's not worth it for me to do business there. It's like it's too unsafe. There's too much crime. And it's just not worth the ROI for us having to, get robbed and having to assure the safety of our employees in a really dangerous area. And it's just easier if we just leave, right? So, Portland, I mean, it's been probably, 15 years since I went there. It's a beautiful city, or has been a beautiful city. And it's kind of your, West Coast jewel city in most folks' minds, where it's beautiful and everyone's out doing stuff, and it at least used to be clean. I mean, it was getting all these awards for like the best designed city in terms of managing sprawl and growth, and fairly affluent to my understanding. But now parts of it have just devolved, I almost want to say, like into war zones. And I just want to share a story with you that a Wealthion viewer has been sharing with me. He's been kind of chronicling his family's adventure. It's he and his wife have a young kid, and he was pinging me, telling me about how he was really hoping eventually to get out of there. And as I was learning about his story, the main reason he wants to get out of there is because his neighborhood has basically turned into a war zone. He was talking about how in the baby's little nursery, they have Kevlar vests hung on the walls in case a stray bullet comes through the house, right? They're that concerned, or they were that concerned about their physical safety. He had a car that was stolen not that long ago, and he had the like low jack tracking in it. And so he called the police and he said, okay, my car's been stolen. It's over here right now. And the police looked and they said, oh, it's in that region? Yeah, it's going to be a while before we have enough officers to go into that part of town. So they weren't able to go get the car for hours and hours after it was stolen, even though they knew exactly where it was. By the time they found the car was considered totaled by the insurance company, not because it had been wrecked, but because so much meth had been smoked in it until the police got there that it was like a biohazard now, right? So, we've heard similar stories about parts of Seattle that are almost kind of like police no-go zones. We've had issues in, Minneapolis and all different parts around the country. My point here is, we have this idea of narrative American exceptionalism in mind, but a lot of, what made this country great, there's a lot of great jewels that are now getting pretty tarnished. And we need to be having an honest conversation with ourselves as a society to say, look, is this the trajectory that we want to go on? Or, do we need to stop our current behavior and adopt things that put this in a better trajectory? I mentioned I was talking to Matt Peipenberg earlier. He's an American, grew up here, and spent a lot of time all around America, but he now lives in Europe. And he had lived out in the Bay Area. He said he came out here a few years ago, and he said it's just not the same place. You go to downtown, parts of downtown San Francisco, and it looks like The Walking Dead, right? You've got just blocks and blocks of homeless people, but a ton of them there are super mentally challenged and mental health issues. But a huge ton of them are just terrible addicts. They're terribly addicted to fentanyl and these other strong drugs, where they're just walking around in a stupor. And it literally looks like a movie lot, from a zombie invasion movie. So anyways, I'll let you chime in here, Lance, but.
Well, I'm a little perplexed as to why you're a little confounded about how this occurred because, look, back in the 60s and the 70s, right? We had sex, drugs, and rock and roll, right?
But I'm not confounded that it occurred. I'm just saying that I think it's occurring to an extent that we are not admitting to ourselves at this point.
Well, and look at the differences between, areas of the country where this is happening, right? What's going on in Seattle and Portland and San Francisco in particular, Baltimore, Chicago, what's going on in those cities in particular that has led to the rise in crime? Right? Defund the police, and we're not going to convict people for stealing, right? You can walk this. CVS is pulling out of cities because you walk into CVS, you loot the store and walk out the front door. Nobody does anything about it. There's no criminal charges filed, et cetera. It's just, so why not steal, right? And this is because this goes all the way back to, this whole view we have. Look, the majority of Americans are not far right and far left. They are right in the middle. And, even conservatives that fall slightly right to the middle, which is a big chunk of America, have some views that are on the left. So in other words, you can be a conservative Republican and be pro-choice, right? There are people that are on the left side of that aisle that are more democratic and more leaning in that direction, but they're pro-life, right? They have views on both sides. And until the late 90s, and really this started to really deteriorate in 2008 with the election of President Obama, and after that, there was a general agreement on the right and left politically about some basic foundations in life, the rule of law, basically being decent people, and drugs were bad, pornography was bad. There were some basic agreements. And so we didn't have a lot of these problems that we had because there were things put in bay. And then now we've kind of gone to this things like, well, you can be whatever you want to be now. You can do whatever you want to do now. If you want to do drugs, hey, that's all good. Don't worry about it. You just be you. And that's all fine and dandy, except you got to have some control over society, because if you don't have it, you wind up with anarchy. And this is the whole point about having rules and laws and things in place, is to keep people from just doing whatever they want to do, because you've got to have that structure or you get anarchy. And we're slowly kind of moving in that direction, kind of more and more. So at some point, I keep figuring out that, or I keep not figuring out, but at some point I figure that people are going to come to their senses and go, wait a second. This all sounded great in theory, defund the police. Let's do that. And people are just going to be good on their own. We don't need a police department. People will just be good on their own. They won't break the law. Okay, we know that doesn't work. So we go back to enforcing our laws, right? So we go back, and I figure at some point we're gonna push the pendulum in one direction, and people are gonna go, hey, I don't like that. Let's move the pendulum back more towards the middle. And maybe we'll get some sanity back into all this. And like I said, I don't care what your political leanings are, right? You can hate this guy and hate that guy, but at the end of the day, what do people want? They want to be safe, just like your guy, right? I want to be safe. I want my children to be safe. I want to be able to go to work and make a living and take care of my family. I want to go to church, or I don't want to go to church, whatever your choice is. I want just basic stability in life. As individuals, we don't want a lot. We just want to be happy, safe, healthy, and have food on our table. If that's pretty much covered, life isn't terrible. And everything else is just kind of, things we work towards. But, it's getting to where now is that even just wanting some of those basic things in life, there's a group of people over here that says, well, if you want that, you're this or that or the other thing. And if you don't want this over here, then you're this, that, or thing. We got to stop that nonsense, and we got to get back to just look, kind of the golden rule, love thy neighbor and do unto others as you want them to do unto you. And life works pretty good under that philosophy.
Yeah. And so I agree with everything you say. My closing point on this is I'm just trying to wake people up to the fact, if they're not already awake to it, that again, we have this narrative of American exceptionalism. We are used to the great advantages that we have enjoyed, and to a certain extent, culturally, I think we think we deserve them because we're the shining city on the hill and all that stuff, right?
Sure.
But we're not looking in the mirror to realize that the shine is kind of wearing off, and we've kind of been letting ourselves go a little bit. And that's manifesting in the domestic issues I just ran through. But it's also correlated to internationally, right? Where America really was, post World War II era, held up as, the big force for good in the world. And now, a lot of countries are like kind of turned into kind of, a bully. And, there's a lot of stuff that we didn't really agree with. They kind of forced us to do, and they started exporting all their inflation to us. And when we get in trouble with them, they, weaponize all this stuff again. So my point is just we're on this sort of downward trend, and I don't know where it ends. And Lance, I hope you're right. I think you're right, but I hope you're right that, everything is cyclical, and we get to a point where everybody says, look, this is not how we want our cities to be. This is not how unhealthy we want to be. This is not how uneducated we want our kids to be. And the pendulum starts shifting back, towards where we want. And of course, that means we as a populace have to take on the responsibility of identifying those values, embracing those values, and then demanding them of our elected officials and holding them accountable. Maybe that's crazy talk, who knows?
No, but it's not. That's what I was saying. If you were alive in the 60s and the 70s, it's always interesting, right? We go through these periods and we go, yeah, this generation's lost. They're done. It's just, it's over for them. Back in the 60s and 70s, that was the way that generation was viewed, right? They were, spitting on soldiers coming home from Vietnam, rioting, doing sex, drugs, rock and roll,
yeah.
right?
Get a haircut, you hippie, yeah.
Exactly, right? And so that generation was a lost cause. And then they grew up into adults and they go, you know what? That really doesn't work well. And they turned it around. And we had the 80s and the 90s, and we had a population that worked and produced and created, and we had a strong economy, and elected Ronald Reagan into office, and all those type of things. And yeah, did we make mistakes along the way? Sure, absolutely, right? We can, numerous of them.
Yeah, and I want to say too, just because we have a lot of boomers watching this channel, you're right. But at the same time too, like a lot of what that generation was involved in doing did a lot of great things back in the 60s and 70s with the, civil rights movement and the women's movement and all that stuff, right? Yeah,
absolutely. And look, there's a lot of good things that are going on right now in our economy, and things that people are wanting, but people that that are having riots and wanting better equality for the for individuals. I'm all for that, right? I mean, we should all treat everybody equally. Everybody should have access to the same opportunities. One group should not be advantaged over another group. We should all be working and wanting to move towards equality. There's a lot of things that we're doing that are not healthy for the economy, and we need to think about those things. And just giving into groups simply because they squeak the loudest isn't necessarily the right thing to do, and we need to realize that. But back then, these kids grew up and they realized things and they changed. And as you get wealth, and there's I wrote an article a while back about the Tytler cycle, which talks about how economies evolve over about a 200-year period, and you move from this working, you basically start with nothing, and then and you're very religious focused because that's all you've got at that point.
Right.
But as you move towards wealth and prosperity, then you start kind of getting rid of that other stuff, and you start moving towards greed and these type of things. And we're in that later stage of the cycle. The wealth in the U.S. is head and shoulders above everybody else. And to your point, we were this exceptional country where capitalism ruled, and that's all still there. We're just ignoring the basic principles of what allows that to work because it's not advantageous for elected officials to stay elected, or it's a disadvantaged group that we're paying more attention to than other groups. And
right, or it's a cartel that's resisting change, all that stuff. Yeah,
exactly. And at some point, the engine of economic prosperity and wealth and those type of things, it's all there. But look, this is a responsibility of the Federal Reserve. This is also the responsibility of the government. We have stopped allowing, we talked about this before, you got to stop bailing out banks. You've got to stop bailing out recessions. You've got to allow these things to occur because that's part of the capitalistic cycle. And if you don't do that, you wind up with these distortions in wealth that cause all these other problems. And look, one of the big problems we have right now is wealth inequality. And we've got 10% of the economy that owns 90% of the wealth. That should not be that way in a capitalistic system. But it's because we don't allow the capitalistic system to work. We have corporatism. Capitalism is fine. Capitalism works great if it's allowed to work. We have corporatism, which is a different problem.
Yeah, totally different problem. And I got to move on here just to get close to the end, because we've been here for almost an hour and a half. But a couple of things. One, I'm just going to put up this image real quick because it's exactly what you were talking about, Lance, which is the hard men create good times create weak men create bad times, right? And that's sort of the cycle of history. You and I have talked about the learnings from the book, The Millionaire Next Door, by Stanley and oh gosh, I'm blanking on the other guy's name, is the one that I've actually interviewed, begins with a D. But they, two PhDs who basically surveyed thousands of millionaires and found out that most wealth, or at least most self-made wealth, was lost within a generation. And it was because the children of self-made millionaires, it's not that they were spoiled and just spent it all on, Gulf Streams and whatever. It was that their parents had to really struggle to become successful, and they wanted to shield their children from the adversity that they had to deal with. And the thing is, by shielding from them from that adversity, they precluded them, they prevented their children from developing the muscles to be successful wealth stewards themselves, right? You think it's an act of kindness, it isn't. And I think in many ways, it is this embrace of adversity that is really what we need. In other words, at the corporate cartel side, they don't want to have anything bad happen to them. They want all their gains to be private, but they want all their losses to be socialized, right? We need to end that part, right? But also, we are, I don't want to say that we shouldn't be, offering assistance to help certain types of disadvantaged populations, especially during particularly hard times. But so much of right now is geared to trying to not let anybody feel any pain. And what that does is it distorts basically the mechanics of capitalism, to your point, right? There have to be winners and losers in capitalism. That's the price you pay, right? Is there has to be losers to have winners. But a capitalist system that's run freely and fairly, history has shown, helps the greatest amount of people generate the greatest amount of wealth per capita, which then can be reinvested in, keeping the whole society healthy in general. You're nodding as I'm saying this. So I'll end it there, because I'm sure we could continue talking about this forever. I just want to mention some data. We won't go into it. We can go into it next time if we want to. But the University of Michigan Consumer Sentiment came out. That's dropped for the first time in 4 months. The core PCE numbers came out. They are declining, but they're still extremely elevated at these levels. And the key one that the Fed looks at, it came down to just barely. The core PCE went from 4.7 to 4.6, right? So my point here is end of the day, the Fed's number one priority right now still is to bring inflation under control. And that is not happening on a rapid pace at this moment in time, right? So for everybody who's expecting the Fed to pivot soon, I'm not saying it's not going to pivot, but it's going to have to be something pretty damn bad to force the Fed to pivot, because they are nowhere close to their inflation goal. And Powell, just spoke recently, and he had the opportunity to try to walk up, the Fed's inflation target, and he didn't. He repeated 2%. I'm going to 2% many times during his discussion.
He did. And look, and by the way, what you're talking about is Fed fund futures that are predicting rate cuts. The Fed is not predicting rate cuts this year. So the Fed.
No, absolutely. I hope I've been super clear in that. Powell is not predicting any.
There's a big divergence between what Wall Street expects and what the Fed expects. And, normally the market is right. And normally the market is right in that they're cutting rates, but the rate cuts wind up being more than even what the market expects. So, but is this time going to be different? With inflation hanging out tough right now, is the Fed going to say, I'm not cutting rates as soon as the market thinks it is? And if that's the case, then we could see a repricing in equities. So we'll see.
Yeah, and Powell was asked that at his last press conference. Hey, there's a big difference with the market thinks and you thinks. And he said, he's like, it's not my plan. My plan is to hold tight. So,
the market didn't buy that, by the way.
Pardon me?
The market didn't buy that, by the way.
And the market didn't, yeah, exactly. The market didn't buy that. So, if the Fed is indeed playing for, credibility or whatever credibility it has left here, it is not going to pivot unless it absolutely has to, or has just an incredible get out of jail free card, like we have another world pandemic where we're shutting down the global economy thing, right? So my point is for the Fed to pivot, it's probably going to have to be something pretty darn bad. Home prices, there's a lot of updates there. I'll just go with this one quote by Robert Shiller, the developer of the Case-Shiller housing index. So really, the country's preeminent scholar on home prices. And he said, quote, "Home prices are very, very high by historical standards. I would extrapolate the downturn somewhat. It's going to continue. Maybe if you have a good chance to delay your purchase, it might be a good time to do it. Things might even get a little cheaper after another 6 months." So, this is sort of the Fed, like they don't want to tell you a recession's coming because they're going to create it. He's got to be careful with his words. But this is the equivalent of him saying, guys, there's going to be a pretty nasty housing correction here.
Yeah.
Yeah. Okay. All right. So last thing, trades. What trades have you guys made this week?
So last week we added some index positions. We added more of those on Monday. So again, just kind of banking on this rally here. These are trading positions we're adding. So we're using either S&P or NASDAQ ETFs for that. And so basically we've just increased our portfolio allocation to equities in that manner because those are easy to put on and take off. And so again, we're just kind of trading this rally from here. And again, with what's interesting about this market is that it's pretty much 10 stocks driving the market. So if you don't have a heavy allocation of those 10 stocks, you're underperforming the market. We're underperforming the market this year because we have these stupid things called value stocks in our portfolio, which I don't understand why we own them. They're there because they provide 4% dividend yields. But they're not doing anything. Everything is in the top 10 stocks. So
yeah, well, this is the Bill Fleckenstein and Michael Green giant mindless robot in action, right? Yep. Capital's flowing in, and it's pre-programmed to go into those stocks based on the way that all these ETFs are allocated, right?
Exactly. It's the passive indexing issue we've talked about before. So
yeah. All right. All right, folks. Well, quick ask for your tolerance here with me. So I am in the middle of a move. I will be actually doing the move a week from when you're watching this, if you're watching it on Saturday. So you may see my background change here. There may be a day or two where we don't have a Wealthion video. I'm going to try to keep my schedule. I'm going to try to do 5 to 6 a week like we normally do. But you know how moves go. They're always worse than you can imagine. And when you get to the end of them, it's like a never-ending marathon that becomes a never-ending sprint right at the end. So we're right at that stage. But hang with me, folks. We'll get through it together, and hopefully quite quickly.
I'm going to give you a free tip. I'm going to give you a free tip to help you out. Okay.
Yep.
So offer to help your wife to pack, and then do everything wrong, and then she'll tell you just to leave her alone, and then you can go back to doing videos.
Oh, dude, I've already learned that one. But I think I'm paying for it as we get close to the because then there's the actual real boxes to move, right? She knows I'm not enough of an idiot that I can't just move a box, right?
Well, you may have to do
yeah. All right. So real quick, folks, this is the last time I'll mention it because we're about 2 weeks out now. But the Wealthion conference was 2 weeks ago. It was amazing for all the videos there, but there are a couple that have been getting a lot of particular rave feedback. One of the ones was from Rick Rule, where he shared over 30 stocks that are in his personal portfolio that have his attention most right now. So if you're interested in potentially gaining access to hard asset investment-based companies, maybe for some of the reasons we mentioned earlier on about de-dollarization and whatnot, Rick has given, like I said, over 30 companies, 30 tickers to go and explore to watch that video, as well as all the other videos from the conference and all the live Q&A. Just go to wealthion.com/conference. You can purchase the replays there. Reminder, there's a lot going on right now, as Lance and I have said. You want to make sure that you are working, under the guidance of a professional financial advisor who can help you think through all these macro trends and how they apply to your specific personal situation, then design a portfolio strategy for you. But as things go on here, as Lance and I have talked an awful lot about here, where active management is becoming so much more important in this type of environment, you want a partner that's executing this for you while you are busy living your real life, right? So if you have a good advisor who's doing that for you, great, stay with them. But if you don't, or you'd like a second opinion from one who does, maybe even Lance and his team there at RIA, just schedule a free consultation with the financial advisors that Wealthion endorses by going to wealthion.com. Only takes a couple seconds to fill out the form. Doesn't cost you anything, no commitment to work with these guys. They just do it as a public service. Lance, as we wrap up here, anything else you want to say to folks before we walk off in the distance here?
No, I mean, pretty much, I would expect, this market to kind of maybe pull back, maybe early next week. If you're looking to add some exposure, you'll be able to use that opportunity. As long as the market stays above the 50-day moving average, you usually will pull back to add some exposure. But, look, the market's in a bullish trend right now. Take advantage of it. And then just don't forget to sell once we get to the other side of this trade.
All right. And, next week, let's dig into, if you have positions you like, let's talk about the pros and cons of selling versus taking like a hedge on that position, right? Where you can stay in the position, but protect if the market does move to the downside. Yeah, so we'll save that for next week.
Exactly. Because you got to also just sell a little bit. You have to sell.
Yeah, you have to sell the whole thing. Absolutely. So let's dive into the mechanics of how you make those decisions as a portfolio manager. All right, folks, if you continue to enjoy these weekly market recaps, even one iota as much as Lance and I do, please do us a favor, support this channel by hitting the like button, then clicking on the red subscribe button below, as well as that little bell icon right next to it. And a reminder that we have had a lot of folks recently mention that they have not been getting the alerts when these videos go out. The way to get the alert is to click that little bell icon. That's what tells YouTube to inform you when we have a new interview here on Wealthion. And for some reason, some people have been getting that alert's been getting turned off on YouTube. So if you're a long-term viewer here, just go down and double check to make sure that's the case.
Hey, real quick, can I say one thing?
Yeah.
Talking about this, I've been getting a bunch of emails from people that have said, on Twitter, they're getting DMs from me about crypto. I don't DM anybody ever. So if you ever get a direct message from me or anybody in my firm, we don't DM anybody. So, those are scams. So just be aware of that.
Yeah, you're hitting a sore button here, Lance, because same deal on YouTube, right? Where, I spend a good chunk, probably 10 times a day, I go to the YouTube channel and spend, 10 minutes every time deleting all of these spam posts by these spammers that are masquerading as Wealthion. And I see the same thing happening on Twitter too. Yep. Blanket statement for everybody watching this. You will never get directly, personally contacted by Lance's firm or mine via social media, and certainly not to sell you anything, right? And a lot of these are kind of crypto scams. They're pretty easy to note once the scammer starts talking to you. But blanket statement, you will never get directly marketed by our firms over social media.
That's correct.
All right. Lance, thanks again for another great week. Everybody else, thanks so much for watching.